Today's guest has built a company that administers over $2.8 billion in assets across 280 entities, helping fund managers not just stay compliant, but truly scale. This is something that I personally have a problem with, and I think it's a great world to uncover because it's not very known. And with over 30 years in the private capital space, he's become the go-to name in fund administration for emerging and mid-sized managers. And as someone who helps entrepreneurs access and allocate capital effectively, I'm very excited to welcome Matt Burk, the founder and CEO of Airyvest.
Thanks, Ahmad. Thank you for having me, man. I appreciate being here.
Matt, thank you for being here. Before we begin into this world of fund administration and fund strategy, what pulled you into private capital and real estate?
Well, I started my career in the consumer finance business doing sales contracts and consumer loans and home equity loans. And I think the home equity part of it was kind of my favorite. That kind of got me started understanding real estate, valuation, and so forth. Led me as I moved on from a couple of different jobs early in my career. I gravitated toward lending and real estate finance. And then after the company I was working for closed a number of their branches, I started my own business doing real estate loan brokering. So I was a mortgage broker in the early days, and then that led us into doing private lending with private individual investors. So we would match one trust deed at a time with private parties for people that couldn't get bank financing. That kind of led me into eventually doing it in a pooled fund format. Did that on 3 or 4 occasions, and then I had people asking me for advice and guidance around how to set up that fund. So that kind of led me to the advisory space, and then the advisory space ultimately led us into helping people do the back office administration, because a pooled investment fund is more complicated from an accounting standpoint than individual deals. So it's kind of been a progression over time, Ahmad, as you know. But I originally got started in it through consumer finance and just enjoyed, real estate concepts.
And can you explain the problem of, because I think everybody understands until the mortgage side when you're lending or mortgage brokering. But then when you're starting to ask for fund administration and accounting, why does that have such a level of complexity? And why were people coming to you to say, hey, how do I set this up? And you went from an advisor to that. But why is it such a difficult space to come into?
Well, I think a lot of people are matching up investors with single assets, right? So I'd say a single asset is not especially complicated. I mean, it's definitely work and so forth, but people can generally understand it, right? If I'm making a loan, let me just made up numbers here, Ahmad, but if I have $1 million loan, right, secured by a property worth $2 million, right, and I need to fund that loan, and you're funding it with private investors, you can either get one investor to put up the entire million, or you can get multiple investors to each put up, 100 or 200 or some combination, and put 4 or 5 investors in that one deal. Right? A fund is then an order of magnitude more complicated than that, because now you have not just one asset, you have multiple assets coming into, because a fund is a vehicle, right? It's an LLC or a limited partnership that is a vehicle whose purpose is to make investments in whatever type of, whether it's real estate or loans or private equity or private credit or oil and gas or whatever, right? But you're in a fund, you're acquiring or originating multiple assets at various points in time, and you're bringing in multiple investors at different points in time. So the combination of multiple or many assets and multiple or many investors, it gets more complicated figuring out how do you allocate, the income or loss or the depreciation, right, or the capital gain, et cetera. How does it get allocated amongst those investors when both the assets and the investors are coming in and out at different points in time, right? So you can imagine it's more complicated than when you just have a single individual asset. So that's the point at which most managers who are raising capital from investors to do real estate deals they may aspire to moving into a pooled fund format, but it's harder. There's more moving parts. There's more concepts. There's more complexity, right? And there's more. It's more difficult. So that's when people start to need or want help with how to set that up properly in the first place. Which is both a business and a legal thing, right? You have to be compliant, so it requires you to hire legal counsel to draft documents, but it also means you need to understand the business components of it. And then once it's up and going, you need to then be able to track and allocate all of that properly. And those are the parts that get complicated.
And is it sort of a growing pain for a manager that once they do one individual deal, two individual deals, then they grow up to try to launch a fund or launch a fund, that they find that this complexity is a little bit too overwhelming,
Yes.
and that's where you step in and help?
Yeah, that is often the case where they've most of the time the people who are doing it, they're good at real estate. They understand how to underwrite and originate and assess the merits of a potential investment or an acquisition of a property or a loan or whatever. And they generally have some ability to raise capital from investors on an individual basis, or that they wouldn't be doing it in the first place. But what they don't usually understand is the ins and outs of the workings of doing that in a pooled format, and they certainly don't often understand the accounting treatment, because most of the time they're not accountants, they're real estate people or private credit people or private equity people. So yes, the answer is very much what you said, which is most of the time I don't recommend, Ahmad, that people go directly from 0 to 100, right? You don't want to go from that to start doing a fund. You need to do it do individual deals for a while. But if you reach a certain stage or a certain point, then oftentimes a fund makes sense. That's the next logical step, but it's more complicated. So that's oftentimes where they reach out to us. On the advisory side, and there's two components to our business. One is advisory, helping people set it up in the first place, and the other is admin, which is back office services once the fund is live and going and is growing, to make sure that they're doing that part of the business correctly. And most of them are happy to outsource it, and the investors are happy to have it outsourced because there's a third party that is overseeing what's going on and is aware of what's happening and is administering the rules of the operating agreement the way they need to be administered.
Absolutely. And I think I said this is a personal problem as well, because I don't think people know how complex it can get and how fast it gets complex. Like it's a very steep curve. It's not a learning curve that you can kind of learn a little bit, but then the complexities of admin, legal, structuring, adding SPVs, making it becomes a big mushroom of complexity that has to work. And when you deal with other people's money, there is no room for mistakes. It's actually they trust you with this, so you have to operate at the highest level. And I think what people need to realize, or what I've learned, is that you need to leverage other people's expertise to make sure that you're not making these, I would say, novice mistakes that you can make at the beginning. What Let's go into mistakes that people are making that aren't leveraging your
Mm-hmm.
or maybe when they come to you, it's already a little bit like you already made a mess. What type of things have you
Yeah.
seen that you can tell us, that so that other people can avoid those mistakes?
Yeah, yes, I've seen many, many different structural mistakes in the setup of the fund in the first place, and they take a lot of different forms. I'd say a common one is that um, they don't necessarily think through the structure of the fund to match the asset model, because there's a lot of different asset models, right? You might be making fix and flip short-term loans. You might be acquiring distressed debt. You might be buying, multifamily property. You might be buying triple net leases. You might be buying, value add industrial or retail or storage or tax lien certificates, or I mean, I've seen all kinds of different things that people try to do. So there's no real one size fits all. So a lot of times what will happen is somebody will have a preconceived notion of what a fund is supposed to look like, and they'll take those documents and they'll apply it to this asset model, but they just really don't fundamentally match. So they get off to the wrong start in the first place, but they don't realize it, right? Because they haven't really dealt with it before. So that's a big part of the value proposition, is trying to make sure that we understand exactly what you're trying to do. Who is your investor base? Like, what type of money are you raising? How big is your average loan size? What's the average duration of an asset? And then which exemption are you using from registering as an investment company, assuming you are, and the vast majority of managers, are using one or more exemption, which is generally 506 Reg D. So yeah, there's all kinds of mistakes that people can make unknowingly, and most of the time it's unknowingly because they don't know what they don't know. They go to a lawyer, and the lawyer is absolutely necessary in the process because you have to have documents that comply with securities law, and so it's a must. It's table stakes. But the lawyers generally, their job is to protect you and to make sure it's compliant, not necessarily that all of the structural economic components match up with your asset model or your investor base, et cetera. Some are very good at it and some, aren't. So it's easy to mess it up before you even get started, and that's what we really try to help people avoid.
And not only is it messy before you get started, it can be very expensive
Yes.
because setting up a fund, talking to these lawyers, there is no lawyer that does fund structuring that is inexperienced. These are high quality, very specialized people, and I think not knowing can cost you a lot more than you can imagine.
Yeah, I've seen people spend hundreds of thousands of dollars in startup costs and then never even launch the fund. I mean, that happens pretty frequently. And you don't really need to spend that much money. And a lot of the question is, should you even be doing a fund in the first place? And the answer in many cases, Ahmad, is no. I'd say more often than not when I'm talking to people who are asking a lot of these questions, once I do some qualifying, some discovery questions, my guidance is I don't think that you should do a fund. You're either not ready, or your asset model, size, deal frequency, its investor base, whatever, is not conducive to it. And so I take a very pragmatic approach to the whole process, and try to help managers make good decisions and set themselves up for being successful. Obviously, as a manager, you want to do the best you can to originate and acquire good deals, and the deals that perform, and that's a whole nother separate conversation around the quality of the assets. And obviously markets move and change, and things can be not what you expect them to be. So I think setting it up properly so that you maximize your chances of success is a smart move.
I'm curious because most managers try to go from the deal to the fund model because of the chicken and egg problem. When you have the deal, usually it's a window
Yep.
of where it's a short window where you need to raise a lot of capital, and if you don't, you might lose deposits, you might not have certainty of close, all these problems that arise from not having ready capital, discretionary capital.
Yep.
And then on the other side, when you do the fund model, you might go on to all these expenses, and you said most cases it's not okay. It doesn't warrant to do a fund because of all the reasons you mentioned, whether it's deal quality or frequency or investor base. Can you give us some rule of thumbs when a fund might be warranted? Or because you said most of the times it's better to do deal by deal.
Yeah.
Is there a middle ground, or what do you recommend?
Yeah, well, I'd say first of all, there is no perfect answer. There's no perfect structure. One is not inherently better than the other. I think they're just different, and there's trade-offs. There are things that are better about a fund, and there's things that are better about individual syndications, both for the sponsor, the GP, and also for the the investor, the LP. Um, so these are broad generalizations, Ahmad, to answer the question. But I'd say um, it depends on deal size. So if you're only doing 2 or 3 deals a year, let's say, and the average deal size is 10 or 20 or $30 million in equity, right, and you're getting debt for the rest, you probably don't want to do a fund, most likely, because you're doing it infrequently enough that it's, even though it's hard, to your point, you got to go out and hustle and raise the money, right, for each deal. You probably don't want to go through and do a fund because it's harder to raise that much money in a fund format and to deploy it that infrequently. So, but I know a lot of clients. We have a lot of lender clients. So these are people that are making, excuse me, loans with the money. And so if you're doing loans that are short term, a lot of fix and flip or bridge loans, that money turns over very rapidly, right? The average duration of that loan might only be 6 months, 9 months, a year. So you don't need to raise nearly as, but the volume is higher, right? So they might be doing 3, 4, 5, 6 loans a month, right? So if you're doing that and the volume is high and the money turns over, then that's much more conducive to a fund, because you don't need to raise as much because you can redeploy the money, right? So there are different situations that are more or less conducive depending on size, investor base. Look, I mean, and some people have an easy time raising money. Most people have a very hard time raising money in a pooled fund. Another consideration is that in a pooled fund, the investor does not get to pick and choose which deal they are investing in. They're investing in a thesis, right, or an idea or a box that you're, as the manager, putting together, but they're not picking and choosing the individual assets that go into that box, right? So the bar is higher because the investor needs to have confidence that the manager is going to be able to make good choices on whatever types of deals that it is that they've laid out in the offering documents. So there's a lot of trade-offs. One's not better than the other. There's no one size fits all.
Absolutely, but I think you did put a lot of clarity into the different levers. I think frequency, capital base, check size, all make into either you should do a fund or do a individual deal by deal syndication. And then you also mentioned that some sponsors are better at raising capital, and that led me to think about your book, Capital Attraction, that you published back in 2016. Can you tell us a little bit more about why you wrote that book? What was the goal with the book, and why should people read it?
Well, the goal with the book was to try to put into a coherent narrative some of these concepts that we're talking about, to help managers think through, the idea of whether they really do want to start a fund or not, and also on the investor side to help investors understand, if they're putting money in private funds, some of the issues that the managers that they're investing with are dealing with. It's been the book has been well received. I'd say it's a lot of positive feedback on the helpfulness that it's provided to people. I do think that the part around the capital raise is one of the least well thought through components of the fund when people launch it, right? Because they've had some degree of success in raising capital on a deal by deal basis, or they wouldn't be contemplating a fund in the first place, right? But I think people underestimate the differences between raising money one deal at a time and raising money in a pooled investment fund format. So that's been a consistent theme I've seen. I mean, we've done the last 12 years, Ahmad, we've done probably 300, 350, something like that, engagements where we've helped the manager think that through. So I've had countless, hundreds, thousands of conversations with people around. And one of my first questions is, how are you going to raise the capital, in a pooled investment fund? And I'd say more often than not, they're not really sure. They have an idea, but they're not really sure, or some of the ideas they have are based on myths or assumptions that they have about how it's going to work that, in my experience, are not accurate. Which is another part of what I try to do, is help them be as realistic as possible about how they're actually going to raise money. Because if you can't raise money, I mean, the business is a dual-sided business, right? You have to have both weights. It's kind of like the old apothecary scale, right, where you put the weight on each side. You don't want to have too many deals and not enough money. You don't want to have too much money and not enough deals. You need to have approximately the same amount of deals and money at all times to make the thing balance, right? And that's very hard to do.
Can you elaborate on some of these myths? Because I feel that capital raising is one of the, I would say the most important skill of an entrepreneur is one of the most is capital raising, but yet, like you said, most people have these misconceptions that I'll ask someone, I'll get all the money. But what have you seen?
Well, a super common one for a lot of, and we work with, to be clear, we work with non-institutional, I'll call them small, new, emerging middle market managers. These are people, below, most are below 100 million, but certainly all are below 500 million. And a lot of them are starting from zero, right? So they're going from 0 to 5 to 10 to 20 to 50 to 100 or more, right? I'd say a very common one is that people think they're going to go in and get institutional capital in their fund. That's almost never going to happen for a brand new or small manager, even if they're very, very experienced on the sponsor side. I mean, and have done a lot of syndications, and even if they have a significant track record. I mean, you can get institutional money on a JV basis, on a deal by deal. I mean, on a deal by deal basis through a joint venture of some sort. But getting true institutional money in a pooled investment fund is almost impossible, except for the big, the Blackstones of the world and groups like that. Um, I never say never, because you see it once in a while, but it's very rare. That's a big myth. Or another one is that we're going to go in and get money from RIAs, registered investment advisors, or broker dealers. Right? Okay, that's also a very difficult market to crack as a small manager. So I think those are probably the two biggest that people overestimate the likelihood of their ability to get larger chunks of money just because they have a fund.
What separates those who are very successful from those who don't break zero?
Well, they have. I'd say the table stakes part, and I don't. I mean, this is just, to me, these are just givens, right? You have to have. You have to do good deals. You have to have a team of people. You have to have an origination strategy. You have to be able to generate, deals on a regular basis so you have product, right? That's kind of table stakes. I'd say I just sort of take that for granted. Like, that's just price of entry. But I think once you have that, the biggest differentiator is people who are good at raising capital and committed to doing it and building out the functionality on an ongoing basis, and aren't completely bullshitting themselves on how they're going to do that. So that's probably the biggest differentiator. I do think too that people who understand that running a fund is a business unto itself. It's not a side hustle or just something you do in your spare time. I mean, running a fund is a serious business, and you need to understand that you need resources dedicated to getting good at that. And people that take it with that level of thoughtfulness and seriousness have a much better chance of being successful, because they're willing to do things that people who think it's just kind of a side gig aren't, like actually having an investor relations team or a capital raising approach, hiring a fund administrator, getting the fund audited, doing the things that make it, a real endeavor.
For sure, I agree with you that the fee of admission is one thing, and then the raising capital, being successful at that side is incredibly important. What about what is your opinion on how the industry has become uh, more conducive to larger funds, or so expensive that it's hard for the middle manager or the starting manager to even get to the starting line? Because as we mentioned before, the legal cost, the preparation, the fund docs, the everything adds up extremely fast. You mentioned investor relations. Like how does someone get started? Because it's definitely a high barrier to entry.
It is, and I would say in some ways, though, man, it's actually there are more resources now than there were when I started running a fund, 25 years ago when I launched my first one. It's actually in some ways cheaper. I mean, there was no investor management software back in those days, right? There was limited number of lawyers that knew what they were doing. There's a lot of the admins were large institutions that wouldn't come down into the small space. So I think you've seen really a proliferation of fund managers after the Jobs Act passed in 2013, right? Because now you could publicly advertise and solicit. Before you couldn't. Crowdfunding came along, and investor management software came out that automated a lot of the things that you would otherwise had to have hired people for. AI is now coming out that's allowing people to do things that formerly took forever. So in many ways, it's actually easier. But I would say that the deal side is maybe harder in the sense that there's so much more information readily available. There's so many more people chasing it, and that it can be harder on the deal side than it used to be. But in actually setting up the fund and the resources available to do that, I think there's more opportunity now than there was 10 or 15 years ago.
Interesting. What about, you mentioned crowdfunding? Do you think crowdfunding has, because I feel it has its moment. It was very popular, maybe when capital was cheap. There was a lot of platforms coming up, a lot of sponsors saying, I'm going to raise money from alternative equity sources or alternative private credit sources. Do you see that dying down? Do you see that here to stay? What's your opinion on crowdfunding?
Well, I think the way that people viewed crowdfunding when it first came out, I agree with you that kind of had its day and it's gone. But I do think the concept of raising money, online and developing more digital-based systems to be able to drive investor dollars I think that is here to stay. And I think the tokenization, blockchain, crypto, decentralized finance, and all that stuff is gaining a lot of steam. And I think you're going to see that really come into the private space in the next few years in a big way, because it just makes so much more sense. There's a lot of advantages to doing it. It's still very early in terms of getting people's confidence in that stuff. Real estate's kind of a old school, type of a industry, and people are slow to warm to things. But I think you'll see more and more digital-based real world assets like real estate and real estate funds over time. And that'll be the new, kind of crowdfunding, is that people are doing it through digital means, but not in the way that they did back when, the Jobs Act first passed and crowdfunding first came around. I mean, there was always a lot of legal questions about the way crowdfunding tried to raise money, because you can't really get paid to raise money for other people unless you're affiliated with a broker dealer, and you got to comply with all those laws, and many of them weren't. Right, and they were trying to come up with ways to get around it, and that eventually didn't work. So now all the ones that are left are basically all fund managers. Not they raise money online from investors, but they into their funds, and then they become allocators into other funds. Right.
For sure. I think that you touched tokenization, and this is something that was particularly interesting to me, and I worked on it maybe 4 or 5 years ago. Ultimately decided to cut that initiative because I felt that there was no appetite for a tokenized real estate asset. I felt that that was a mirage of a secondary market that really isn't there. Like that to me was like, why do you build something if there's no market for it? And do you see it the same, or do you see it the opposite, that eventually there will be that freedom of liquidity in a traditionally unliquid market.
I I see it both ways. I think you're right that 4 or 5 years ago was definitely too early. Right now today may still be too early, but I do think eventually it gets there. And it's like a lot of things in life, right? It's like it's not until it is, right? And people don't think it's possible until it's there. So I think eventually it comes around because it's just there's too many advantages to it to for it not to come around. And as people age out and the new people who are digital natives age in and AI keeps developing and more technology comes to the fore, I don't see how it doesn't become something big eventually. Now, I'm not pretending, Ahmad, to tell you that's 1 year or 2 years or 5 years or 10 years or 20, but I think eventually it becomes, a very big thing.
For
Right
sure.
now, it's still very
I,
expensive. It's costly, right? I mean, managers aren't going to drop
yeah,
50 or 100 grand to tokenize their offering. It's especially when there's not the demand there yet. But at some point, I think that flips.
I agree with you. And I actually think it will work only if it's a trophy asset, like something that actually brings people to the table and says, I want to own
Yeah,
a part of a Formula One racetrack or a
yeah,
part of
yeah,
the Empire
yeah.
State Building or something like ridiculous that brings people to say, yeah, that is I'm exposed to real estate and something a little bit cooler. But when you talk about like what my company does is very boring stuff. It's usually the more boring, the better it is. But it can be
Yeah.
the you know a adapt and reuse or a value add strategy, something that's very it doesn't really bring people to be
Yeah.
like, oh my God, I'm so excited
I,
about this. So I think the digital, like you said, the people who are digitally native, they want quick stuff, quick returns, but not what we do.
yeah, and I look, and I think that it's usually going to start from the top down, right? The really big
For
guys
sure.
will do it first because they can afford it, and then they'll work out a lot of the kinks, and then eventually it trickles down into the smaller balance world, and then
Yeah,
it becomes a little bit more widespread, and then pretty much everybody's doing it, and then at some point, the investor says, like, look, if you're not tokenized, I'm not doing it because I can't. Like even crypto investors. I mean, I have seen this, Ahmad. There's people, coming out. They've made money in crypto, and they do everything on decentralized finance, and they don't want to hold money at a normal bank in the traditional finance way. And so, but they want to put some money into something more conservative, or than crypto, which is a real world asset. But they want to do it in a way where they can hold it in a digital wallet and right? And in that case, I do think you're seeing some money come into more traditional asset classes like real estate that was made in the crypto world, but that needs to be still held digitally. And that I've seen some amount of money kind of coming into this space on that basis. So I do see that. Now it's not giant. I mean, they're big dollars in absolute terms, but they're tiny dollars in the scheme of the whole. So, but I see that percentage growing over time.
for sure. No, that's a great point. And uh, what about what has changed since you started? Uh, is there more automated compliance, investor portals? What is very exciting that's happened in your field in the last few years?
Yeah. Well, I'm an old guy, Ahmad, so what hasn't changed since I started, right? I mean, we used to, take pictures with a Polaroid and put them on the back, and then it was 35 millimeter, right? And then eventually you put them on a CD, and now you take them with your phone, right? Or things like you used to send all the documents in. To this day, some people still do this, right? You print the documents out, you put the sticky notes on it, and you Federal Express it, to somebody to sign, as opposed to now you just go online and you just got a portal that sign everything digitally and so forth. So massive amounts has changed since then, and it's changing all the time. So I try to stay as much at the forefront of it as we can, and I've been guilty of doing what you talked about, where I've seen things coming down the pike that I believe are going to, change things, but they don't happen as fast as you think they're gonna, and it's easy to get too far ahead of the curve. So trying to figure out when to go out at the bleeding edge and when to, be a follower is not easy.
Yeah, yeah. What, after all these years, what inspires you to keep at this work? What brings you to the table and says, yeah, this is why I do this?
Well, I really enjoy helping managers and investors understand the business, particularly is when you try to make the leap into a fund. There's just there's so much demand and usefulness for that knowledge and that service that it's enjoyable at this point to just help people build their business and understand and do it better than they would otherwise do it in the absence of being involved. So I enjoy that part.
Would you ever launch a fund again?
No, I'm out of the no. I've run a bunch of them over the years. I would say I think it has gotten much more difficult to be a good investment manager. There's so many things that happen in the world that are outside of your control that make it tough to do. I mean, it's easy to get too broad, to go over your skis, to do things that have a good thesis but that maybe don't pan out the way you thought they're going to. So as time has gone on over the last 10 years, I've gotten increasingly enamored with the helping other people do it, because there's lots of people that want to do it. I'm not one of them anymore. So I'm much more in the advisory administration services business than the trying to pick and choose the next best thing and which asset's going to be better than another and execute those strategies. There's so many people trying to do it. I'd rather help others that really want to go do it with the parts of it that I know that they struggle with, that I know intimately.
For sure. How do you keep yourself from like getting excited about someone's thesis, or you think, oh, this manager is so good, and keep an objective eye? Because I think emotions play a big part in how people make decisions sometimes, even though they shouldn't. But we are emotional beings, and
Yep.
we think sometimes with our heart. What's your strategy to stay objective?
Well, I mean, the role that we play is not to pass judgment on the merits of the individual strategy. As our role is to make sure that they, whatever the rules of the road are that they establish in the operating agreement or the limited partnership agreement, are being followed, and not necessarily to see which particular game that they're playing. Right, so. It's the analogy I would use is there's a lot of different games, but each of them has a set of rules. That's what we're here to do, is make sure that the rules of whichever game they're playing are being followed, not to pass judgment on which game is better than the other. So as time for us in a role as an administrator or an advisor, it's more, if people ask me in the scope of the engagement, I certainly can put my 2 cents on whether I think their strategy is all that great or not, but that's not why people are hiring me, and that's not the role that we play. So it's pretty easy to maintain impartiality in the sense that, we don't want to deal with bad characters, right? So if I know or can tell that people are not on the up and up, we're not going to work with them. But beyond that, we're not trying to figure out which one's better than the other in terms of the investment strategy.
I like how in the finance world it's very much stay in your lane. It's I do the investments, I do the underwriting, I do the investor relations. Like, it's very much stay in lane, because like you said before, and I agree. It's extremely hard to get this right. To be an allocator, it's just I call it, I compare it to a competitive sport, like combative sport. You need to be extremely on your A game every day and work with people that are able to bring you the right knowledge so that you can execute properly. Let's say that someone wants to raise their first $5 million fund. What's your top piece of advice?
Well, if I would ask them a question is like, where do you think that money is coming from? How much of that 5 million are you very, very confident you're going to be able to get, and where is it coming from? And almost always the answer is, friends and family, people that you know well. So I'd say that's a great place to start. And then I encourage people work from the inside out as much as you can, because if here's your friends and some people's friends and family is tiny, some is bigger, right? But that's the circle of influence that you have when you start. Work from there and then work in concentric circles out from there, as opposed to try to go all the way to the outside. People say, I'm going to go get institutional money. I'm like, no, you're not. It's not going to happen. So start with what you have, work the base that you already have, and then try to work from there. Referrals, I mean, dinners, other ways of working with those investors that you have a relationship with, generally going to stand a much better chance than going outside and trying to do something crazy. At the same time, I think people then need to build some sort of a system whereby they can increase their capacity over time to effectively get the word out on what they do, and develop additional investors outside of that sphere. So ideally, you start with the former, add the latter, and just know that it's going to take time. It's usually does not happen overnight.
That's great advice. I agree. I've seen a lot of people, competitors looking for they want to go big, and then they say to go big I need to go to institution, but the institutional capital is extremely reserved
Not in a
for
fun
those
format.
who have been
Yeah,
exactly.
not in a fun form. I mean, like, and when you hear, and even using the term institutional capital, what does that mean, right? Is it in the fund world, that usually means like a pension fund, or an endowment or a foundation or family offices, big check writers. But the big check writers, generally, a lot of them, they either, their criteria is almost to the point where it's a non-starter in the first place. I mean, like a pension fund, they don't want to invest less than 50 million bucks, or 25 million would be small. Let's say 50 million bucks, and as an emerging manager, and they don't want to be more than 10% of the fund. So if you're not a $500 million fund, then there's not even a conversation to be had. If institutional capital, if you're doing one deal at a time, you can go to a sizable fund and do a JV. I mean, they'll come in and put up 95% of the money, right, on a JV basis, but that's on a deal by deal basis, and they'll have control rights, and they'll have all kinds of things that tie you up pretty good as a sponsor, but you can get 95% of the money. Okay, but that's not a fund, and the fund that's putting up that money, they're raising money from pension funds or other large investors. So is the institutional money, is it the pension fund putting money in, or is it, the big fund that's trying to put money in a smaller fund? Right? But most big funds aren't putting money in a smaller fund. I mean, they want to do one-off deals. So there's just
Yes.
almost, I mean, the percentage of people, Ahmad, that can get true institutional money as a new manager, I mean, it's incredibly tiny.
I think that it's also knowing where you are in the food chain.
Yeah.
It's very important to know your limits, know your capabilities, and then execute. Because you can make more money, you can make more impact. You can whatever drives you by successfully completing one deal with an institutional partner in, if that's what you want, then try to raise a fund that then has this all discretionary capital, which we won't raise it, like you said, it'll be one in a million. It has to be a star manager that left one business,
That's
perhaps
right.
that's the case. Well, I actually think that there's so much more to uncover. This world is fascinating, and I don't think enough people know enough about it. How can people reach out to you, follow you, so that they can understand what really goes into the back end and empowering all these managers to do the right thing and to keep growing?
Yeah, I think I'm very active on LinkedIn, so that's a great place to find me on LinkedIn. Or Matthew Burk and Verivest. You can also email me, matt.burk, B-U-R-K, at verivest.com. But either of those two, LinkedIn's, I think, the best. I'm very active there, and I post pretty regularly on topics related to this stuff. So if anybody's interested in this esoteric stuff, then they can follow me on LinkedIn.
For sure. I am a follower. I know that I keep learning from you. So thank you again for coming and answering all my curiosities. I hope others also learned. And I think the most important thing I get from this conversation is that you need to work with people like you that know what they're doing so that we don't get into trouble and that we can get our investors' money into safe hands, into safe investments, and then into the right execution, and then everything works well. So thank you again.
Well, I appreciate you having me. Thanks so much, and best of luck to you. And let me know if I can ever help you out. And thanks for having me here.
Pleasure. Thank you.